Hey, it is Mortgage Monday, and today we are going to go over how your credit score is actually calculated. So about 35% of your credit score is based on your payment history. So if you have a 30-day late mark or 60-day late or 90-day late payment on your credit report, that is a big hit to your credit, and those take about 7 years to fall off. And just after that, about 30% of your credit score is calculated on how much credit you have available. So if you have a credit card for $5,000 and you're using all $5,000 of that, if you're at 100% utilization, then that actually negatively impacts your score. Now, on the other hand, if you have $100,000 of credit available and you're using maybe $10,000 or $15,000 of that, you have a low utilization at 10 or 15%, and that is actually very good for your score. Then right after that, about 15% of your score is calculated based on how old your credit history is. So if you have no credit history, that really hurts your credit. On the other hand, if you have 30 years of credit history, that's actually really good. Then we have about 10% that's based on new credit or maybe credit accounts you just opened, such as a brand new credit card. If you take hard pulls on your credit, it can actually negatively affect your credit. A soft pull does not negatively affect your credit though. And then lastly, 10% of your score is the mix of credit you have. So if you have a whole bunch of different kinds of credit, such as, a home equity line of credit, a mortgage, some credit cards, maybe a personal loan and an auto loan, it shows that you're using all kinds of different credits, and lenders will actually improve your score because they see you are managing all these different kinds of credit in a great way. If you found this video useful, please share it with your family and friends. This is Leland the Realtor, keeping real estate simple. Have a wonderful day.